Stop what you're doing. Last night, while you were asleep, they began engineering the narrative. A story about Bitcoin hitting $225,000 was fed to the market. While you were scrolling your phone today, the consensus was manufactured. New all-time highs are guaranteed. But while the crowd was being positioned for a celebration, the smart money wasn't just leaving the party, they were rigging the exits. Right now, every voice you hear is calling for the moon. But the code embedded in the charts is flashing a signal so severe, it has to be addressed. A brutal 25% plunge to $68,000 isn't just possible, it's now the path of least resistance. This isn't a guess, this isn't an opinion. $68,000 is a magnetic price level the market is being pulled toward. And here is the betrayal. The very data they are using to sell you on a rocket launch is secretly building the launch pad for a catastrophic failure. The stakes for your capital have never been higher. This is how it happens. The noise is impossible to escape. It's a perfectly polished, coordinated symphony of bullishness. The story is clean, it's compelling, and it is designed to be dangerously incomplete. They tell you the new spot Bitcoin ETFs are a permanent tsunami of institutional cash. They point to giants like Bank of America finally entering, saying, "This creates permanent buying pressure. That price can only go up." They tell you the Bitcoin halving guarantees a supply shock. With a finite number of coins, every single one an ETF buys makes yours more valuable. It's just simple math, right? Then they point to the economy. They assure you the Fed will cut interest rates through 2026. This easy money is rocket fuel for assets like Bitcoin. This is the story of a perfect storm. ETFs, scarcity, a friendly Fed. They see the recent sideways price action not as a warning sign, but as a healthy pause. It's a brilliant story, and it's exactly what they need you to believe. But here is what they are not telling you. While the mainstream was hypnotized by the headlines, the market's very foundation began to fracture. The fact that you are still watching means you are already ahead of 90% of the market. Because the raw data tells a story not of a launch to the moon, but of a structural floor that is about to give way. These are the three triggers for the inevitable plunge to $68,000. Pillar 1, the technical trigger chain. The price chart is screaming a warning. First, look at the weekly chart. Bitcoin is visibly failing to hold the $90,000 to $92,000 level. Every single push higher is met with overwhelming force from sellers. This creates a pattern of lower highs, a classic signature of sellers taking control. A breakdown here doesn't just dip, it has a primary target of $74,000. But $74,000 is just the first domino. The real target, the price magnet, is $68,000. Why? This is where two historic, undeniable indicators collide. The July 2024 highs and the 200-week exponential moving average. The 200-week EMA has for a decade been the final line of defense for Bitcoin. It's the ultimate floor. Here's the part they don't want you to see. Bitcoin's price has not touched this average in over 3 years. That is a dangerous historical anomaly. A rubber band can only stretch so far before it snaps back. A 25% drop to $68,000 would be that violent snapback to reality. The daily chart is even more urgent. It is forming a textbook bear flag. We've seen this movie 100 times before. It's a pause that builds energy for the next, equally powerful leg down. A break from this pattern first targets the November 2025 lows around $82,250. The conclusion is inescapable. The charts show exhaustion, not strength. Pillar 2. On-chain and the liquidity vacuum. Do not look away. This next part explains how the trap closes. The story gets worse when you look under the hood at what investors are actually doing with their money. You've seen the headlines, "Whales are buying." This is not just a misreading of the data, it's a deliberate misdirection. The real story? Whales are not buying, they are selling. Wallets holding between 1,000 and 10,000 BTC have systemically offloaded 220,000 Bitcoin in the last year. This is a massive distribution pattern. This is what smart money does right before a major top is in. Think about what that means. They are using the retail buying frenzy as their personal exit door. This selling is happening inside a dangerously thin market. Spot trading volume has fallen off a cliff. The network is becoming a ghost town. This creates a liquidity vacuum, a trapdoor. In a market this thin, it doesn't take much selling to cause a catastrophic price drop. There are simply not enough buyers to absorb the force. The stage is set for a sudden, violent move down. This is how people get wiped out. Pillar 3, the macro catalyst. The final piece is the chorus of seasoned traders who are now sounding the alarm while the fragile economy is being ignored. While Wall Street relentlessly pushes $225,000 targets, analysts like James Wynn and Brannigan Barrett have both independently forecast a violent test of the $67,000 to $68,000 level. Why? They see the same structural weakness. They see a market priced for a perfect world that is an absolute fantasy. The idea that the Fed will cut rates is not a guarantee, it's a prayer. If inflation proves stubborn, rate cuts are delayed. That isn't a small problem. That's a detonator for risk assets like Bitcoin. And those institutional buyers? Analysts at Standard Chartered warn that big buyers might already be running out of steam. We already witnessed historic outflows from ETFs in early January 2026. That was the first crack in the dam. If a real risk-off event hits the global markets, those same ETFs will become engines of forced selling, amplifying the crash. But here is what they are not telling you. While the mainstream was hypnotized by the headlines, the market's very foundation began to fracture. The fact that you are still watching means you are already ahead of 90% of the market. Because the raw data tells a story not of a launch to the moon, but of a structural floor that is about to give way. This is the 4-step chain reaction to $68,000. It happens fast. Step 1, the bear flag on the daily chart breaks down. This triggers an immediate, rapid drop toward the November 2025 lows around $82,250. Step 2, this break triggers a horrifying cascade of liquidations in the derivatives market, vaporizing weak support at $74,000. Step 3, the thin spot market cannot handle the selling pressure. The liquidity vacuum opens. The price falls through open air as there are no buyers left to stop the collapse. Step 4, the final capitulation. Price is drawn down to the one place it has to go, the historical magnet at $68,000, where the 200-week EMA waits. A full 25% correction, orderly at first, then all at once. This is how you get trapped. This is how they trap you. You see the first drop to $82,250 and you think, this is it. This is the dip I was told to buy. So you buy. You see the mainstream headlines twisting the on-chain data and you think, the whales are buying with me. I'm smart. So you hold. You ignore the broken technicals. You ignore the weakness on the weekly chart. You see a tiny bounce and tell yourself the bottom is in. But you are buying directly into weakness. You are providing the exit liquidity for the very sellers who have been distributing their bags for months. The real bottom forms when there is blood on the streets, not when the news tells you it's a buying opportunity. To stay ahead of this, I'm not watching the news. I'm watching my dashboard for reality. 3 things. The weekly RSI. It has broken below the critical level of 40. As long as it stays below this line, sellers are in absolute, undeniable control. ETF net flows. Are institutions still buying the story? Or are we seeing consistent, panicked outflows like we saw in January? This data will reveal if the institutional demand story is fact or a fading narrative. The 200-week EMA. This is the ultimate line in the sand. A touch and decisive hold of this level around $68,000 would be the very first signal that the cleansing might be over. Until then, the path of least resistance is down. This is a moment for extreme caution, not for blind optimism. The fantasy of a straight shot to $225,000 is a dangerous siren song that ignores a mountain of hard evidence. The signs are now undeniable. The technicals are not just bearish, they are terrifying, pointing to a major correction with a clear magnetic target at $68,000. The on-chain data is damning, showing smart money is actively selling to retail in a dangerously illiquid market. And the macro environment is a powder keg. Right before the collapse, it always looks exactly like this. The path of least resistance is down. A 25% correction to $68,000 isn't just a possibility, it is a high probability based on the data we have right now. This isn't about fear. This is about risk management. This is about not being the last one to react. Protect your capital, stay informed, and be prepared for the volatility that is coming. Not financial advice, for educational purposes only. Thanks for watching.